Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is Perpetual Inventory System. When we talk about inventory, we have two types of inventory. Manufacturing inventory, it is not our topic today. However, we have videos about that and they are in our video description. Merchandising inventory, that is our topic today. What is the basic difference here? Merchandise inventory, we purchase it and we sell it. We purchase A, we sell A. We purchase soda, we sell soda. Manufacturing, we purchase A, we sell X. We purchase woods and we sell furniture. Okay? And the merchandise, cost of merchandise inventory includes purchase plus any other cost necessary to get goods in condition and location for sale. For instance, shipping be added to our purchase price. And when we talk about merchandise, we have two methods. Periodic inventory system. It is not our topic today either. However, we also have a video about periodic inventory system. And what is the difference? Uh, Cost of goods sold, we record it only at the end of each period. And we use a formula here. Cost of goods sold equal beginning inventory plus net purchase less ending inventory. What is the difference? Perpetual continually adjusts the inventory account for each change in inventory caused by a purchase, sale, or return. So we have our ending balance of inventory after each transaction, not only at the end of our period. And also the cost of goods sold. We have cost of goods sold at the end of each transaction and not at the end of each period. And we have some methods here. We have three basic ones. We have another one, for instance, a specific price and so on. But let's work with the three most important ones. Average cost, FIFO, and LIFO. So let's work with this slide here combined with our Excel file. So average. Assume inventory cost is a mix of all goods available for sale. Average is weighted by the number of units. In my opinion, the easiest one, especially if you are working with Excel. So let's do it. Excel here. FIFO, LIFO, and average. Let's work with average. Scarping Corporation purchased baby toys from Trodster and then sell them to customers. Company begins it at 2020 with inventory of 2,000 cases and a purchase price of $100 each in each on hand. So let's stop here for a little bit. Beginning balance. How much is our balance? It is what? Well, 2,000 units. Price $100. So our total will be quantity times price. So it will be $200,000. And let's add this info to our T account. So inventory beginning balance $200,000. Additional 9,000 cases are purchased on account at a cost of 120 each. So here we have a table that is very useful for perpetual inventory. Purchase, sold, and balance. So purchase here, how many units? 9,000 units. How much? 120. So our total will be quantity times price, a little bit more than $1 million. What is the journal entry? If we were working with periodic system, our journal entry would be purchase and accounts receivable. Perpetual inventory, we don't have temporary accounts. So everything goes to inventory. So inventory, 1 million. Accounts payable, 1 million. And it goes to our inventory here, our debt. How much is our ending balance? That is the difference between FIFO, LIFO, and average. how do we record our ending balance? Our ending balance will be, when we work with average, previous number plus our purchase, less our sold if we have it. So 11,000 units. Price, this is the average price. Average price is total divided by quantity. We have no total yet. And the total, how do we do that? Beginning balance or previous balance plus purchase less sold. 1,280,000, and our purchase, our average price is higher because our price is higher. Okay. Oh, sorry. 10.5 thousand cases were sold. All on account totaled $1,837,500. Selling price of 175. Okay, accounts receivable 1,837,500. Sales revenue here, and this journal entry will always be the same. It doesn't matter our inventory method. So let's copy and paste this one to our LIFO and our FIFO because it doesn't matter our inventory system. Our cash will be the same. Our revenue will be the same. However, we have a cost of goods sold. How do we do that? And why it's so easy? How many units we are selling? 10.5. How much is our average price? 118. How much is our total? Quantity times price. So our cost of goods sold here, 1,221. And our credit will be inventory as well. So on periodic system, we have a huge journal entry at the end of our period to close accounts, adjust numbers, and so on. Here, no, we have only the regular journal entry, so no journal entry here. So here, inventory, our credit, we have an ending balance of 58. Let's double check if this number is right. So let's copy and paste this formula here. And 58, and we're good. Okay, so this is the average method. And later we will compare them. So first one, average and ending inventory. Ending inventory here. Okay, let's go back to our PowerPoint. What do we have here? FIFO, first in, first out, assumes units first acquired are sold first. So if we purchase, sold, and we always sell the first one, or purchase, sold, but we sold the first one, not the second one. Our ending inventory consists of the most recently acquired units. Let's go back to our Excel. Exactly the same data. Okay, so we will be working with same data. Beginning balance. Beginning balance is also the same for everyone. $200,000, and it is our $200,000 here. Uh, so inventory debit, inventory here, credit inventory here. Okay. Additional 1,500. Wow, it was not 1,500. It is 900, 9,000. Okay. Now let's do the same. And let's copy and paste here, guys. Give me some seconds. Okay, we are almost live here, so that happens. So, okay. Whoa, 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 whoa. That's not the right info. Oh, yes, that is. Okay, now we're good. So, additional 9,000 cases. Price 120. So, our total will be 1 million. That doesn't change for always for our method because the purchase just as our sales. It's cash based or it will be cash someday, so we don't change it. Here we don't have average. So we must disclose our purchase here separately. So beginning inventory plus purchase. Okay? And the cost of goods sold, how much is it? 10.5 thousand cases. So FIFO, first in here. That's blue here. It is the first out. So, okay, do we have 10.5 thousand units beginning balance? No, we have less than that. So let's have all of them here. Okay, we still need some numbers. We still need 10,500 less 2,000 units. 8,500. How much the new price? 120. Our total, $1,020,000. How much will be our cost of goods sold? Will be the sum here. And inventory, 1,220,000. And how much our ending balance? This blue one here is closed. So we have here 9,000 less 8,500, 500 units. And how much the price? 120. And then here we need to check if it is the 60. 500 times 120, 60. We are good. So let's compare FIFO and average. And let's consider that we are working with rising prices. That is usually how economy works. Cost of goods sold. FIFO a little bit lower than average. So we have greater net income here, greater tax here. And ending inventory is a little bit high because of cost of goods sold a little bit lower. Okay, so usually if we want to go for paying low taxes, FIFO is not a good method. However, if we are working on paying a lot of dividends, FIFO is better than average. And let's go to LIFO. LIFO is the opposite as FIFO. Less in, first out. So assumes unit less acquired are sold first. So the ending inventory consists of first acquired units. Exactly the same, but the opposite. Okay? So it's not the same. Oh, let's go back here. LIFO. Same number, so beginning balance will be the same 2,000, 100, 200,000. That is our beginning balance here. Our purchase inventory here. Cost of goods sold is the inventory there. Purchase, also the same. And such as FIFO, we need to split our numbers here. Beginning balance and purchase. If we have additional purchases here, we would be recording all of them over there. Okay? And now sales, 10.5 thousand cases. Do we have it in our last purchase? No, we don't have it enough. So we will sell all of these purchases here. 9,120, 1,000,000. How much do we need? 1,500. 10.5 less 9,000, 1,500. How much? 100 equal 1,500 times $100. So $150,000. How much will be our cost of goods sold? The sum of it. 230 inventory here. Oh, and we need to record our purchase. Sorry, inventory 180. Accounts payable 1,080,000. So here our T account debits and credits, our ending balance must be $50,000. Let's do it. 2,000 less 1,500. Our price 100. We have here our 50,000. That is the same as our T account, so it is right. Let's go to our comparison. FIFO, the highest cost of goods sold. So the lowest income, the lowest tax. Any inventory 50, the lowest inventory. So we have the lowest tax here and the lowest income. And here, what do we have? LIFO is only permitted in the US. If you are not in the US, I want to let you know that IFRS forbids LIFO. Okay? And IFRS, you can choose either FIFO or average. In the US, you can choose from all of them. However, if you choose LIFO for tax, you must choose LIFO for dividends. That is what the US called it LIFO conformity rule. But you can choose average for dividends and LIFO for, or average for tax, FIFO for dividends in the US, no problem. In a lot of countries, you can also choose one method for tax, one method for financial statement, but in some countries, don't. You must use the same for tax and financial statement. So if you're not in the US, take a look at your local financial standards to check if you can choose one method for tax and the other method for financial statement. Okay, guys, so thank you so much. Please subscribe our channel. You will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarping. Like this video. And if you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.